Hello, everybody. This is Paul Hirschenberg with Hirschenberg Financial.
Hughes with Southwest Wealth Advisory Group.
Welcome to our October 2020 call. Brad, we always start off with you reading our disclosure statement, so go ahead and kick us off.
Securities and investment advisory services offered through Woodbury Financial Services, Inc., member FINRA, SIPC, and registered investment advisor. Hirschenberg Financial, Southwest Wealth Advisory Group, LLC, and Woodbury Financial Services are not affiliated.
All right, well, wonderful. So I think we always like to start off with a kind of a recap of our last call. And in our last call, you had said that you really felt that the markets right now were range bound. In other words, it would be kind of hard for them to go really way too much higher or really way too much lower. They would kind of stay in a range. Do you still believe that way?
I do. Again, it's going to take some level of a catalyst to get us out of that range. We didn't see stimulus. Obviously, we do not yet have a vaccine. We're in the middle of earnings season, and we've had some good earnings numbers so far. But I think you have to get deeper into that earnings season and get some of the larger tech names reporting before earnings can be what really pushes it higher. And also, we're coming up really close to the election. Once we get past the election, you get past that uncertainty. I think then we can still be range bound. The hope is it's a higher range, so higher highs and higher lows, and we're able to move forward and start seeing higher index levels.
So you brought up the election. So obviously, by the time we're shooting this thing on Thursday, 4 or 5 days before the election, by the time this is actually viewed by anybody and it gets through compliance, the election will hopefully be over. We may or may not know who won yet. So, I think that just to put it out there again, how do we feel the markets are going to behave short-term versus long-term based on who wins the presidency?
Short-term, depending, no matter who it is, you're probably going to see some choppiness. It could be because the likelihood of a contested election on either side. I don't think either one's just going to concede on Tuesday night. But you get through November, you get into December, and definitely into January. I think we have a very high probability of lower volatility and the ability for high quality companies to be able to move forward and go higher.
How worried are you about a second wave of coronavirus hitting us? Obviously, we're kind of in the middle of that right now, and it appears to be picking up steam. How does that translate to stock market?
I'm not as concerned about it as I was when there were whispers of it through the summer. And the biggest reason being, we already kind of have a blueprint as to what works if we have a second wave. The likelihood is your work from home stocks still work, your technology companies still benefit. We're trying to avoid areas like energy, like travel related, things that are really impacted by the virus today anyway. And those would, I think, continue to struggle and maybe even be hit worse than they are now. But those that have worked in the past, and I say the past, those that worked through the summer, I would have to believe would continue to work going forward.
The one thing I'm asked all the time is, why is there such a disconnect between the economy and the stock market? And I know we've talked about it in the past, and really, when you look at really who this is being affected by, people that are being affected worse by Corona, it really isn't everybody. It's a small percentage of workers, very important people, but definitely it's not everybody that's participating in this downturn. But in general, why is there always such a disconnect between economies and stock markets?
Well, I think one thing you have to look at is how do you judge that stock market? Most people look at either the Dow Jones or the S&P 500. So even if we think about it as the S&P 500, the 500 largest companies in the U.S., how is that index constructed? The top 10 companies make up 22% of that index because it's based on the largest company being Apple is the largest holding. If those top 15 companies all perform well, and they all tend to be very technology heavy, the market itself, the indexes will do well. The companies that have less exposure in that index tend to be your travel related companies, your energy, your restaurants, things of that nature, where we've had a struggle. but they only make up roughly 9% of the investable stocks, whereas it's, I want to say 20% of the people that are employed. So you have, like saying, it's a much larger portion of those that are employed, but a much smaller subset of the investment arena, if that makes sense.
It does, definitely. We talked last time about kind of where we underweight our portfolios and where we overweight our portfolios and how that's always evolving and changing based on what's going on. Do you see any changes between last month and this month as far as where you want to put money to work?
Not really. I think the only thing to be looking for, we're going to get to a point where it makes more sense to start looking at more international, and that's going to be less about what happens in Europe and Asia and more about the US dollar here locally. So if we get to a situation where the US dollar is starting to lose steam, and I've talked to organizations like a Fidelity that believes we could see a 10 to 15% decrease in the US dollar. If that's the case, it makes international investing extremely, extremely attractive. Going back in time, 2007 to 2013 was kind of a frame where the dollar was weak, and international actually outperformed the US, although we don't think that it does, but it did.
Will there be a time in the future where you're going to buy more of the beaten down names, the companies that have been beaten down, like some of those travel companies and just companies that pretty much could really rebound well once the virus is under control? Because we've been so tech heavy. Will there be a time where you flip that?
I wouldn't say flip it, because I don't want it to sound like we're going to sell technology to buy travel, but I think there is a time where it makes sense to start folding those in and increasing that exposure to those areas. But I don't think that could be I wouldn't want that to be a conversation until we have a vaccine and we know kind of what that distribution process is for a vaccine, and that I don't know that we'll ever know what the side effects are, but if we can have a high level of confidence in that vaccine. Because what's really going to drive those travel stocks, if we think about it, it's business conventions and conferences. And without conferences and conventions and business travel, we can take all the vacations we want, but that's what drives the travel industry. And we have to have those come back, and that will not happen until we have a vaccine, I don't believe.
And even if it does, I mean, that might really never, well, I'm not going to say never, but that might not come back the way it was. I'm fearful of that myself, that, even when we do get a vaccine, that companies will start doing less of those type things.
If you're a CFO and you have a decision to make, and a conference costs your organization, I don't know, $150,000, $200,000, maybe it ends up being $1 million. I don't know what those numbers are, but you can do it virtually, or you can do it every other year virtually and save those dollars. That goes straight to the bottom line. It makes all of these organizations that more profitable. That's another reason that Wall Street outperformed Main Street through the summer, is the how quickly organizations, publicly traded companies, saved money and saved expenses on things like conventions, which would have happened throughout the summer. That's the convention season, and it didn't happen. They all got They all got canceled.
Right. One last question. So in previous calls, me and you have had a lot of conversations about this, about starting to actually buy individual stocks for our clients. Is that still in the cards? Is that still the plan?
I don't think it's out of the realm of possibility, but what I think is more attractive right now are the thematic exchange traded funds that we've been able to utilize, whether it's the different areas of data storage, cloud computing, innovation, things of that nature. I'm a lot more comfortable with that right now. To buy individual stocks, I think you have to have a more of a, for lack of a better term, a segmented market where you really have just a few companies that are really doing well, and it's called a stock pickers market. And I think we're in that right now. I think we can still be as broad-based like we are, and have it be beneficial and accretive to clients.
Well, that's great. Brad, thank you very much for joining us today. And we look forward to seeing all of our clients soon, hopefully at some point. And yes, so please, you guys have a great day, and we'll be talking to you. I'm sure we'll be talking after the election. So have a great day, and we'll see you soon.